Key Financial Indicators, prepared for and presented at the 2016 Square One Entrepreneurship Training Program. Square One is a program of the Center for Emerging Technologies. CET is an affiliate of the Cortex Innovation Community. Square One is funded in part by the Missouri Technology Corporation.
As I was listening to the other, I was here for both the earlier presentations, and just a couple things came up that I thought, I don't know if you guys have been through this before. How many of you have raised capital from outside investors to this point? A couple of you. Oh, of course you. Yeah, so this is really, I think, this is really new to you. So when you're talking about options, it's kind of, you got to make sure you bring it back to what does that really mean in terms of giving away part of my company. It's really the same as giving it away to investors, and instead of getting money, you're getting their time and service and energy. But when you look at a cap table, it has the very same effect, right? Because you're going to take that equity and you're going to be judged on how much of your equity is outstanding, and that's one of the factors that's going to go into the valuation of your business when you raise the money now, and then presumably if you're doing well, you're going to raise more money, and then you're going to raise more money. So this is kind of done in steps a lot of times, the capital raising. You're not going to go out day one and raise $5 million because you're going to give away all your company. You won't have anything left to do. So my rule of thumb, as I've raised different rounds, has been that I want to sell 20% of my company at a time, and kind of limit it to that if you can, because that way you kind of have some more room to increase the valuation, and then sell another 20% of the company, hopefully at a bigger valuation, get more money, and not dilute everybody too much. So there's a real balance as you go forward about how much money do you take when. It's all timing, right? This is a timing thing again. You have to take enough money so that you don't run out, but you have to take as little as you can to not dilute the investors who are already there. So this is just an example of a real simple, I think when you guys are getting started, you see these very complex models and complex cap tables as you grow, but when you're starting, make sure that you understand it, and that when your model is, I have never used I guess I use my own models as a starting point, but anytime I join a new company, it's a new model. Every time I work with a different, because there's just so many, a lot of the elements are the same. Your payroll is the same. What you're going to pay on top of payroll, which is, your benefits and taxes and all those things. Those are all elements that are the same, but the revenue part especially really needs to be customized for whatever business you're running. So the simpler, I think, the better, because you have to, it's a living document. Like she said, it's something when I have a model, I change it at least once a month and go through the whole thing, rethink all my assumptions, because things change and you learn new things. I've done for Apistry in 15 years, I've had I don't know how many revenue models, but we've been a software company where we sell licenses. We've been we've sold services, people hours, we've sold platforms, we've sold equipment, we've sold, software as a service. So it changes as the markets change. When I started with Apistry, cloud computing was just like a thought, and people were saying it'll never happen, it won't work. So there's always changes in the markets and always changes in the way that people think about their revenue and how to build it up. But just one example quick, this is one of the founders I was working with who started a product company, and he had 3 partners, or the 3 of them, there were 3 founders, and they had shared the equity. This isn't exactly it, because I changed it to protect the innocent, so that in case they got around it, they wouldn't think, oh yeah, that was mine. But they had divided up the equity. Most of it was held by the founder, and then his 2 partners he brought in. And then they had set aside some for future grants. So when you're raising money, the new investor coming in, who are the most important, besides the product itself, really what they're buying is you as a team. Are you the team that can execute? So they want to make sure that every one of those people in that company, or at least the top management people, are highly incentivized for this to work, because it's not going to be easy, right? You're going to have a hard day. You're going to have days where you think, why am I doing this? So they want to make sure that you know why you're doing it is for that equity, right? So every time you raise capital, that's going to get diluted. And so at some point, you're going to have to issue more shares into that plan. So we're talking about, how do you use that or how to use those shares to incent your employees. But when you do, you got to remember that goes on your cap table, just as if it was an outstanding share, even if it's an option, they haven't bought it yet, you don't give anybody a stock certificate for it, but it's a promise of equity, so it has to go on your cap table, and you have to make sure that you track everything that you do on your cap table very carefully. So that's one of the key things whenever I go in and work with a new company is I get out this cap table, and I make sure that every promise that they've ever made to anybody is on that cap table and that they understand it and there's documentation for it. That's one of the things that when you're raising money, an investor will want to go in and look at every one of these transactions. Cap table. I'm saying cap table. So when you're talking to investors, one of the things that you'll learn is there's a lot of lingo, right? So capitalization table is often referred to as cap table. So they'll say, show me your cap table. It's just really it's just a listing of every share you've promised to anybody or you've sold or whatever. So anything that you do has to be on this cap table. So the question that the guy asked me was, how can I take $250,000 from an investor but keep my percentage at 51%? So that's what I solved for here. He wanted to maintain his percentage at more than 51%. So you can get it that way, and that kind of gives you. That's always a really hard question when you're doing your first capital raise is, what is the value of this company? Do you have a product? Is it just an idea? It's sometimes worth more as an idea than it is after you start selling it, because then reality creeps in to the equation, right? Because before you have revenue, you have these projections and you can go, look how great this is going to be, right? And we're going to do this and this and this, and it's all going to be up and to the right. When you actually start selling, sometimes your nice up to the right charts take little dips. It may be because of seasonality. Nobody buys anything. If you're selling to academics, they take off for the summer. If you're selling to bankers, they take off for the summer. They take off for the fall, and they take off for the Christmas season too. So you better sell to them in the summer or in January, February timeframe. So there's lots of seasonality issues and those kind of things. And those are explainable, but I'm just, when you really get to what your valuation is, there's just so many factors that come into it. But when you're first starting, somebody's got to put a stake in the ground, right? What is it? And a lot of it comes down to what are you willing to give up to get that first chunk of money?
So one question was, would that be recommended to do after the first round to already be at 51%?
No, it does. That's just his objective, right? So every case is going to be different, just like every one of your models is going to be different. Every one of your cap tables is going to be different as well. You might not want to give up any equity, and you might want to do all self-funding, and so it just really, it just depends on how much money you need to raise, and how good are you at selling the future of this company. How much does somebody believe that if they put their money in and get 20% of the company, that someday it'll be worth, what you say it will be in the future. So that was the objective, and that's, so this is a scenario. Here's a scenario. If he's willing to accept that your valuation is $1.5 million after he puts his money in, then you can keep your 51%. So you have to convince somebody that a company that has $20,000 in sales, but a really great product, is worth $1.5 million.
So is the sale companies only option or the company will hold, maybe getting more product sales and then getting the profit to the investors?
Say that again.
So basically, the exit is 1 year, right? If there's other way the company keeping growth, they will not sell the company. Eventually, the investor will get in.
Yeah, the investor, his exit is only going to come, or the valuation that's real only comes at the exit, right? Is that what you're asking? Saying that, when does that, every time you sell a piece of equity, you value the company again. So if we, at the beginning, if he said, my company is worth $1 million today, but if I'm going to keep my 51%, I have to increase the value of it to the new investors so that when I, tell him, he's going to pay $1.50 for the share, that at the end of the day, there's $1.5 million in valuation. But then there's really, could you sell it for that today? I don't know. It probably not, because it's not far enough along. But the investor is banking on that by the time you get to the next round or get to the next stage, you might not need to raise any more money, and so he's got his 20% and he can ride the growth as you grow. Or you go down the road and you have to raise additional money. So you always want to kind of think 1 or 2 steps ahead as well, that I'm going to raise this 250 at this valuation, and then when I raise the next 500 or $1 million, what is my valuation? Hopefully it's going to increase. And so you sell more, or you sell less of the company but get more dollars for it in the future than if you raised all that money today. But the investor doesn't really know the outcome until somebody buys their shares at the end when you're selling the company. But that's kind of a rule of thumb of the 20%, and also that the equity to the employees is usually the investors want it to be between 15 or 20%. So you always have to factor that in as well, because now after this money, my employees only own 17% of the company. So the next investor may want me to put more shares into that pool. And those could come out of the founder, or they could just be created as new shares, and that's a decision the board will make going forward.
Is there a, well, for lack of a better idea, a universally assumed lifespan of this type of a company? Because one of my hiccups, if I were to ever look for funding, is that I haven't created this company to last 10 years to be sold.
Yes.
And so, like one of my mentors cannot figure out the hurdle over that, because this model always represents an end sale.
Right.
So why would an investor want to invest in me if there's no return?
The ways that you deal with that in an investment document is that there's a put to the company, so that if you don't have this company sold in 7 years, I can come to you with my equity and force you to sell or to buy back my shares. So you either raise money from somebody else who wants to be in your company, or you sell the whole company. So there is usually written into an investment document some kind of forcing function. There may be a dividend that keeps accumulating that you want to kind of stop by getting rid of that investor. So if you really know going in, venture capital might not be the right way to finance your business, because those funds tend to last 10 years. They have a lifespan where the fund itself, as an investor, and I'm investing other people's money, usually if I'm a venture capital guy, then I have a lifetime of that fund, and you can only make investments for a certain period of time, and they want that equity returned within that 10 years. So you also want to make sure you know where in the cycle is that investor. Is it a new fund, or is it an old fund? And they're going to be more patient if they're a new fund than if you get the last dollar of that fund. They're going to put pressure on you to have an exit earlier than otherwise would.
They try to invest their fund in the first 3 years of a 10-year fund, right? So that there's enough time that those companies that they invested in have a chance to make an exit within the 10 years.
Yeah, and so it's important to understand who your investor is. If it's a venture capital, look back to who are their limited partners. Like our limited partner at Purina or at Apistry was GE Capital. They have a very patient, long cycle, versus a venture capital who might have a lot of different investors. If they have one investor, they're probably more aligned. You don't have to worry about aligning all those investors. But if a limited partner that you have 10 of them, you might this guy's like, yeah, I want my money back. So it's just, you got to know your investor, I guess, and make sure that you're time horizon fits with their time horizon, but they do someday want a return, yes.
So how do they determine the multiplier, like revenue or profit or?
So the,
Is it revenue?
right, at the end of the day, you know, there's a sale of the company, or goes even into when you're valuing the company for when you have revenue. That's why I said sometimes it's the ding if you have revenue, because they have they have a reality check on you, right? So you have all these projections, and it depends on the industry. Software as a service companies is what I'm most familiar with, can go from 10 on the high end to 3 on the low end, probably 3. And they've actually come down quite a bit. In the beginning or about probably this time last year, 6 or 7 was not unheard of, as if you have $1 million in recurring revenue, which means every year you have customers who are going to pay you $1 million, you could pretty much take that million times 6, and that's your valuation, 6 or 7.
And so that's as a function of revenue, not EBITDA. What would be the circumstances where valuation would be based on EBITDA?
A more mature company, I think, would get EBITDA. I think a lot of the companies I work with don't have EBITDA. They have like negative earnings still. They don't make money yet because they're still investing. When I was working in industry and they actually had EBITDA, then you're probably more mature. So even though it seems counterintuitive, it's still going to be 3 or 4 times EBITDA as your valuation, because that's a mature company if you've got earnings and so you have a lot of history, and you probably don't have the growth potential that an early stage company would have. So that's one of those things that you really need to understand about your industry, is what are these kind of common multiples and what should I expect? That's another way to say to the valuation question that the guy asked me. So now I got to go back to him and I said, you want $1 million, you want your business to be valued at $1.5 million. Is that anywhere in the realm of reasonable? Because you have $20,000 in revenue. No, but I'm going to have, $2 million, and so yes, it'll be. So you have to be able to defend your multiples, but it really will vary industry by industry, and revenue model by revenue model. So like retail stuff tends to be 1 times revenue. So if you're selling a consumer product and you have $1 million in revenue, your valuation is going to be $1 million. If you're selling software as a service, your valuation is going to be higher than that. Now the difference a lot of times in that is that the gross margin, which we talked about just in this last presentation, for a software company should be 80, 85, 90%, because once you've invested in developing the software, there's not a whole lot of cost to deliver it. I can shoot you the copy of it, shoot you a copy of it, so that once I've developed it, there's not a lot of cost to sell it. Whereas a consumer product, you have the product cost. You can't really get rid of that product cost. You can reduce it by getting bigger volumes and buying in bulk and all those things, but you're always going to have some relative cost of margins that affects that valuation. So it really will depend on the industry and where to get that kind of data. There's a lot of data on the web about that. I also look at EDGAR a lot, which is it's the SEC's website, and you can look up, if it's a publicly traded company, you can look at their quarterly and annual reports. And what I do that for is to look at their multiples and their key performance indicators, which we're going to talk about in a minute, which is why I'm here. But those are the kind of things that you look at. And this is where you get into when we talk about the 409A evaluations. One of the big things that goes into that evaluation is what are other companies like you, how are they valued? And there's a difference, but at least you can get some kind of trajectory about that. Like what is a software as a service company like Salesforce? What is their valuation as a multiple of revenue? Or as a multiple, they'll have EBITDA, maybe not, they might be at a loss. But so you can look at publicly traded companies and get those kind of multiples as as a starting point, but they're going to be way different than what you'll experience as an early stage company.
That's a quick question. So let's say you're not going to raise money for your company through VCs, but you are considering non-equity like grants.
Yes.
Could you use that to evaluate your company to say this is what my company's worth based on these non-equity grants you're getting, or no?
Yeah, I think that you can, I mean, the valuation is in early stage, pre-revenue valuations are always hardest, right? Because you don't really have anything to specifically hang your hat on. But a grant is always a very good, I think, positive factor in valuation, because you can say, I've got this non-equity money that's contributed to developing my product. So I've got this money going into the development that I didn't have to give away equity for. So as an investor, you get the benefit of that as well, right? Because they don't have to give you as much money. You're going to hopefully continue to get that grant money. So the more grant money you get, the less investment money that you have to take, and then they don't get diluted, you don't get diluted. So it's good for everybody as long as you're continuing to get that grant revenue. The other thing it does, it kind of puts a stamp of approval on you, right? Because you're going to go through a grant writing process. It's a very competitive selection. And if somebody comes and sees that the NIH has given you $5 million, that's a really a good plus. And so that should go into the valuation process to say, here's why I think I'm worth X. And you list that as one of the factors.
To what degree would you say this is true or not true is the role of geography, where you're looking to raise money as a factor in valuation?
I think that valuations in St. Louis are tough. I think they're tougher probably than in other parts of the country from what I understand. I've never raised money I've never had a company on the East Coast, West Coast, but I have gone out and talked to people on both coasts. They tend to have more money. They tend to be wanting to put more of it to work. So getting $50,000 or $500,000 is not something you're going to go to the Valley or to the East Coast for, because those guys want to put in $5 and $10 million, not $500 and $1 million. So what we tend to see here is that, and I think this is a real issue for St. Louis companies, is that you're always raising money because you get it in small increments. And your valuation, you might be able to hold your valuation a little bit higher at the beginning, but then eventually when you have to raise that bigger money and then you go to the coast, then you're going to get dinged, I think, for having raised it here. So it's a tricky proposition to raise money in St. Louis because it's really time consuming. It's very competitive. There aren't a whole lot of sources. You have to be very creative. You have to have a lot of coffees, and you have to, go to your friends and family and, and just start networking. And things like this are great. Go pitch to every business competition. This just takes a lot of time. And the people I see being successful are the ones who are willing to call on whoever, will hear them about money.
Sorry to ask another one, but so then the next question, the logical question from that is, in your opinion, in your considered judgment, what percentage of time should a company be focused on raising money versus, essentially,
running the
engage
business
with customers?
Yeah, I mean, as a CFO, I'm very engaged. I mean, that's what I do. That's my top priority all the time, is doing whatever needs to be done to support the fundraising activities. The CEO closes the funding. They sell the deal. I do not pitch the company. The CEO does it. So if anybody comes to you and tells you they're gonna raise you money, they're not gonna raise you money. You're gonna raise you money. It just is impossible. I just haven't seen anybody be successful unless they're the one who really believes enough to go out there and pitch that business and just believe it in their heart and soul that they're going to be the one who's going to do this successfully. You have to do it yourself.
Do you have a way to value
Intellectual property? It's a similar question to the grants, I think, in that having a patent is another kind of validation that your product is unique and the patent office has agreed that it's unique, and that you've spent the money to protect it. Apistry, you know, that's how we started, was with intellectual property, and so for a long time, that's what our valuation was based on, that we had this idea, and we've had to defend that patent. So it's really interesting. Software patents are really hard to get now since the Alice ruling. I don't know if anybody here is into software, but it's really made it very difficult to prove that your software is worthy of a patent, because what the Alice ruling basically said was that if you can do something on or without a computer, then you can't get a patent to computerize it. So their example was that the Alice company did a escrow account and computerized escrow accounts, which is, you know, it's not that complicated to create an escrow account, I guess, but software is very complicated, and you can't really do it without a computer. So there's this difference, I think, in the way that, and it's being litigated now in the courts, and they're starting to kind of define more and give more basis for kind of re-establishing patents for software as a value. But it's up in the air. So it's kind of one of those things where that's, again, how much time do you spend, how much money do you spend patenting something versus going out and try to sell it, get that first mover advantage, get customers, proof points, and then the patent becomes less of an issue. But, you know, physical product is probably different, that the patents are more defensible than with software patents. I don't know what you're thinking about patenting, but it kind of depends on what the intellectual property is, I think, right now, how valuable it is, and what, you know, so an investor who invests in software companies might not value a software patent right now. They just say, go out and sell it, and then prove it to me it's valuable that way. So anyway, I think I'll go on to my key performance endgame. So sorry. I get sidetracked. No. All right, now if I can do this. So what I was asked to talk about was key performance, and I think maybe you and I should have been flipped too, because I'm finance and he's the key performance guy, but I'm going to talk about his stuff so he can ask me questions about it. So, but there's a mountain on here for a reason, right? This is climbing the mountain, and I don't want to scare you off of this, but creating companies is hard work, at least in my experience. That it's and especially software as a service companies, because it's just, you have to kind of keep your eye on the prize and the goal and make sure that you have the story about how you're going to get there. So, it's really, you can look on the web and you can find all kinds of presentations. There's all kinds of SlideShare. Have you guys been out to SlideShare as a website that is a good source? I mean, when you're doing your putting together your investment presentations, go look at, think of a company that is similar to yours. If you're software as a service, go look at LinkedIn's presentation. When there's investor presentations out there, there's all kinds of stuff on key performance indicators as well. What are the key performance indicators that are important to your business? Now that's for you to decide as you are growing your business, but it's also, there's very accepted standard performance indicators depending on what business you're in. So I'm familiar with software as a service, and so those are the kind of things that you have to know inside and out, what they are, how to calculate them, what they should look like. What is a good, when you talk about like ratios, what is a good gross margin ratio? What is a good EBITDA ratio long term? You have to know and be able to talk the talk with investors. And that's when when you're doing your modeling, kind of the end goal of those, from my perspective, is these key performance indicators. And are they reasonable? Can I defend them? Or if it's a hockey stick, does it get crazy? Like I have to have 1 million customers and my market's only 100,000 customers that I can sell to. So they all kind of play together, is make sure that you understand what those are for your market and know what they should look like too. You know, what is a good performance in this industry? But I just, I kind of, I started out just looking at, what the definitions and, so educate yourself generally about key performance indicators, what are leading indicators, what are, like we talked about earlier this evening, the ones that are lagging, which are the historical things. And you're going to be judged on those, right? So you're going to have to track them. You might not always be proud of them, but hopefully you put in place things to get to where those key performance indicators are really getting to be things that you're tracking, and just so that you can understand your business, but also be able to communicate with an investor who's familiar. I guess your best investor is always going to be somebody who's interested in your market. So really when you get into the, past all of the learning about what they are, why do they matter? And I think, from my experience of working with a management team, is that they help you think through your business and know what you have to, what really are the key things I need to focus on. Besides raising money, which takes up a lot of your time, you're going to have certain things that, the management team has got to be familiar with, or as a CEO, am I on the right track? And what are the things that tell me I'm on the right track? And that's really why they matter, is to make sure that you're moving in the right direction and you're climbing up that hill. And then, so you want to make sure that your team is all on the same page with you, right? That they understand, what it is you're trying to accomplish and how are you getting there? How, communicate with your team, either their objectives that they have. So if it's a sales guy, is he tracking all the right things that you need to get to communicate with your investors? So it's a good way to get the team all on the same page. When I'm talking about key performance indicators, I'm usually talking about them with an investor. So this is where, you get through the whole business plan and all of the selling of the company, but in the end of the day, the investors get to the financials and want to know the financial piece of it and know that you understand it and that you have a good plan and that you understand what are those key performance things that are going to drive that business. So that's why you need to learn to kind of talk the talk. Like with SaaS companies, it's your CAC ratio. What is the CAC ratio? And, so I have never heard of that. Why would you know that? And so, so understand what it is. What is a CAC ratio? So it's a customer acquisition cost, right? So CAC. So those are the kind of things.
I'm sorry.
But go ahead.
I was just going to say it's customer acquisition costs or lifetime value of the customer.
Right. So there's a concept of what a lifetime. What if you get a customer today, how long are they typically going to be a customer? This is a software as a service thing. So, if you're a consumer product, does a mother buy, one pacifier? Do they buy 5 or do they buy 10 over the lifetime? How many kids do they have? So, you might not get that granular, but as stores, you might say how many, if I get a particular retailer, how long can I expect them to carry my line? If I take a drug to market, how long is the life cycle of a drug? Whatever that, whoever that customer is, if I get one, and they're, a lot of times we break them into segments. We have, one of the companies I work with sells to banks, and banks, you look at large banks, which would be $1 billion in revenue, and then there's medium-sized banks that have hundreds of millions, and then there's little regional banks. So, if they're a large customer and you get them, they might have, $20,000 a year. If a small one might be 5. So, and then how long do you keep that customer? So if they get, if you get $10,000 a year from that customer year after year, how long before they outgrow you, go to a different product, switch, whatever. So on average, a software company is about 3 years. So until you have history, you have to figure out kind of benchmarks and use those. So, you know, you might not have 3 years of history, or you might not have 3 months of history, but you have to kind of pick a lifetime value that is reasonable. And so you take your lifetime value and then you divide that by how much did it cost me to get that customer. Now, how do you come up with that number? So the customer acquisition cost, now these are things that are, you know, that you can read about and understand from a perspective of a certain kind of company. So I look at it from a software company's point of view. Customer acquisition costs include my sales costs. So you take the whole cost for the quarter. Say, how much did I pay my salespeople that quarter? How much did they travel? How much did they go to trade shows? How much did they take people out to dinner? How much did they use Google AdWords that quarter? How much did they pay a lead generation service for leads? You know, those are all the kind of things that go into your customer acquisition cost. You know, it might be sponsoring a trade show. If you're a scientist, it might be, you know, speaking engagements and those kind of things. So just, you know, whatever industry you're in, anything that goes into acquiring a customer is a customer acquisition cost. And then you want to make sure that, so then you take, you know, how much did you create in lifetime value? $1 million in new lifetime value, but I spent $500,000 to generate that. So I have a 2 to 1 would be your lifetime value ratio. So, you know, you have to understand how they calculate them and then kind of try to apply that to your own situation.
So if you have a service, you're providing a service, and within this service, there could be different options for a particular client, but in the best of all worlds, you'll have them to go through the different stages of it before they outgrow, like they become large or medium-sized business instead of a small business. When you're doing your key performance indicators, would you recommend, like what do you recommend looking at the key performance indicators across, in the best case scenario, from the time they're in until you want them to go through all these levels, or just individual if they only come in for this or that?
Yeah, what you might do in that case is you can create your own, right? You can always create your own ratios or things that you want to track. So in your case, you might want to track, you know, how many of my customers moved from stage A to stage B? You know, how many of them were, you know, just purchasing this one service and now they're purchasing 2 services and they've upgraded. So when I track software as a service companies, I track new revenue from new customers. I track upgrade revenue. If somebody is spending $1,000 last month and they decided they needed more, they added it may be new seats, it may be additional services. So you might say, you know, this customer was $1,000 a month and now they're 2. So those are upgrades. So I track all those upgrades. There's downgrades. So I want to track downgrades too separately. And then I track churn, which is when you lose somebody. So all those factors get tracked separately and then get tracked as one thing as well, which would just be your change in your revenue. So you can look at it in detail, those key performance indicators, really understand what's going on underneath. And then you can look at it from an overall basis, because somebody might say, you know, what's your growth? And your growth is the net of all those things. You know, I had $10,000 in revenue last month. This month I have $12,000. So I had $2,000 new revenue in the month, and my growth rate was the 2 divided by 10 or 20%. So you got to learn how to kind of talk those ratios very comfortably about, you know, the changes, what you're measuring, how you're measuring it. So as long as you understand it and can communicate it, that's what your investor is going to want to look at. So, you know, I think that that's one of the things the investor is going to get at. I think the more you can get up there and say, you know, these are the key things that drive my business: the number of customers, how much they're spending a month, how, you know, what are my growth rates? Those are the kind of things that people tend to not think about when they're putting together projections or business model or their business investor presentations. But that really speaks to me is, do you understand who your customer is and how they behave? Is if you can model those key performance things. So that, investor, that gives them that extra level of comfort that you are going to be a good steward of their money, that you know how to spend it to get those key performance indicators to drive.
And just in support of her, it's like music to my ears, is whenever I was talking about the investment conversations and narrative, think if you could speak confidently, intelligently, and accurately to the very things that Gene is raising versus somebody, and then you're in competition with somebody that's like, I don't know, we don't even know what that is.
No, we don't track it, we don't understand it. So
we don't track it, we don't understand it, and where would you be putting your investment dollar? Is somebody that can articulate that well, or somebody that's it's still a company that's still figuring that out?
yeah, I think one of the things I see people being really successful at is if they come from an industry. Like I helped a guy who spun out an idea. He didn't spin out. They didn't spin him out. He did it on his own. Went from Express Scripts, saw like just like a niche play that he thought people would buy this service, but he knew how to talk the way that they talk at Express Scripts, right? He knew how the industry worked. He knew what was important. He could talk the lingo, and that's kind of what this is. Kind of boiling that lingo down into key points that you want to make to your investors. So that's one of those things that I think why it's really important to understand why you're doing it, and then that they'll also compare you to other companies, like with software as a service. Growth rates are really key, and that goes into your valuation question too. If you're growing at 10% versus growing at 20%, your valuation is going to be much higher at a 20% growth rate. So, and you kind of get to know as you talk to investors what are kind of the gold standards, they call it. One of the investors told me, he goes, well, 20%, that's the gold standard of software as a service. So, where are those bars? What are the things that they're really looking for when they're looking at companies to make sure that, oh, that wasn't the right thing to do.
Did you say that there was a monthly rate, that 20% was a monthly rate or an annual rate?
Well, it depends on what you're comparing. In my case, I was comparing last month's revenue to this month's revenue. So it's a 20% month over month growth rate. You might do quarter over quarter. If you're small, you kind of want to make these numbers be as impressive as you can. So you might want to just focus on quarterly, because if you do monthly, you tend to have a lot of this going on, and the more it can look like this, the better. And the bigger the numbers, the more impressive. So you might want to speak about, in my quarter growth. And that's what a lot of public companies would do. They grew 20% quarter to quarter or year to year, those kind of things. So you always kind of tell the investor what you're comparing it to, right? Last year, last month, last quarter.
We have about 7 minutes.
Oh my goodness. Okay. So, so the key things, this is just kind of a little list of some of the key things that from a revenue and sales metric perspective, these are going to be different depending on what kind of thing you're selling. Contracts and revenue, as you get into the details of this, when you have a contract, like if you're doing you might have a long-term contract with a customer. I might have an annual contract but get paid monthly. I recognize the revenue on a monthly basis. So there's a lot of times a difference between contracts and revenue. So that's one of the things I always point out to my investors. Number of customers, monthly recurring revenue, we've talked about that one before. Annual recurring revenue, $1 million is sort of a key mark to go over. So know where those key points are that an investor wants to hit. Revenue per customer gives you an idea of how many customers do you need to get to those points. Customer acquisition costs we talked about, and then some of the other, the ratios and those kind of things. Some of the things that are maybe more predictive, we talked about earlier tonight with marketing qualified leads, sales qualified leads, How many trials are you doing? A lot of times software as a service companies will do a trial. What's your conversion rate on those trials? You know, if you do 10 trials in a month, how many of them are going to be customers 90 days from now? You know, if it's 20%, you got to do a lot of trials. If it's 70%, you know, that's a really great ratio. So you understand if those are good or challenging ratios. Growth rates are very key. And then, you know, your change in revenue from month to month. Oh, I went backwards. Another thing that kind of is another key leading indicator would be some of the things that you might want to track as you become operational. These are, again, software things where you would have customers calling in trouble tickets, but you could, for a consumer product company, you know, do you get customer complaints? Do you get returns? What does your social media say? There's a whole nother world around social media tracking as well. And so I don't know if you guys get into that, but that is not my area, but I know that there's a lot of things to track about how many how many times people are looking at your stuff and, you know, all that kind of stuff that you want to track. So, you know, as you develop your business, you know, you have to, these will change, and as the stage of the company changes, you'll also want to keep these fresh and relevant to what you're doing. With software renewals, or, you know, might be repeat customers, if somebody cancels on you or returns, product usage activity, can you tell how much someone's using your product? Do you see it in the media mentions and social media mentions and those kind of things? Okay, now this goes back to our financial discussion from earlier. Other key metrics, the one key thing is never run out of cash, right? That's my mantra in life. So when you get to the, you know, as key performance indicators are kind of like an end product of your model, cash burn should be a very key part of your model. At the end of the day, how much I get very simple. At the end of the day, at the bottom of my thing, I always say, how much cash did I receive from customers? That's one line. I track it month by month. How much cash did I receive from investors? Track it month by month. How much cash did I spend? Just one lump sum. At the end of the day, you should know exactly how much cash you spend. Now, if you know, salaries are usually a big piece of that. Product, you know, do you order it in month 1 and have to pay for it in month 3? You know, you have to know when those cash things are going to hit. When do you have to pay your insurance costs? If you have product insurance liability, a lot of times that's an upfront one-time hit. You know, what are the one-time hits? What are the things that happen every month? So you spread those out, model them, but at the end of the day, do I have cash on that bottom line still? So you take your beginning cash, add customer revenue, take out your expenses. Is there money left at the end of the day? And then from there, the next most important thing is how many months do I have left? So if you're averaging, you know, you might model it out that way. So at the end of the day, you can say, oh, that, you know, there's month 10, that's when I run out of money. So I got to start raising money 6 months before that. So you always know, you know, make sure you plan in advance. This is your planning hirings. You have to plan when you're going to raise money so you don't run out of cash. Revenue, growth rates, market share is another key aspect of when you're putting together a plan. And investors, you know, after they see what your product is and what your team looks like, you know, maybe the next most important thing for a lot of folks is what is the size of the revenue or size of the market that you're going after. Sometimes that's a really hard question in genetics, which is what Apostry is doing. That's a very hard question to get at because there's not a lot of data. You have to make a lot of assumptions, but you have to do the exercise. I mean, we've spent hours and hours and hours as a team coming up with 3 different ways of modeling the market. It's not something you take lightly. You really got to understand who is your customer exactly. Like, is it in this company, who do I talk to sell that product? Do I talk to IT, or do I talk to the business manager? Do I talk to the marketing manager? Who is it within that company do I need to get to get a sale? Is it 3 guys? Is it is it, I have to go through all these steps, understand your customer, how do you get to them, and how many of those people exist, and how much are they going to buy? So somehow you have to get to that market as a total, and then you compare your revenue to what the total is. And that total should be growing over time too. So you have to not only know what it is today, but you have to understand how it grows, how that market, the total market is growing, and hopefully you have to just get a very small piece of it to get those revenue projections that you have. And so I use that as in my model, is I'll make sure that my percentage of revenue or percentage of market is always a small number, and show that to an investor. And then one of the big things a customer or an investor will know is when do you stop burning cash? What's your break-even point? That'll be a key question that people ask you. When do you break even? How much sales do you need so that you can stop taking investor money and just start earning your own way? That's a really key point. And then, product, that's just, for another day, I guess. Just like, so then it comes to how do you present these to customers and to investors, to your team? You should be able to use the same kind of reports for both your investors and your team at the end of the day, but you can create graphs and charts and just all kinds of different ways of presenting this kind of data, but come up with a format, use it consistently, and hopefully it looks, you see these little dips in there. Those are not good, but you have to be able to explain it if you do have a dip, but something like that looks pretty good, right? So, and one of the things we pointed out here is that we're kind of growing at this rate, and then all of a sudden you hit a spike. What happened here is we signed a big we had an endorsement from the ABA. So, you have something like that happen, there's your spike in revenues that you see. So you don't know that's going to happen when you start, but those are the kind of things that you want to take credit for. So my curve is going up. So that's just another, thing that you see when you track things like this, is that you can see those kind of movements. Questions?
1 or 2 questions before we wrap up for the evening? I'm sorry?
I thought it was very helpful, I know that much.
Good.
Yeah.
Thank you.
Thank you so much, Keith.
You're welcome.